Most people think buying a forever home is the safest financial decision they can make. That idea feels responsible, stable, mature. You buy one house, you settle down, you raise a family, you stay there for 30 years, and eventually, one day the house is fully yours. No landlord, no rent, no uncertainty. That's the dream most people grew up hearing. But something changed. The math underneath that dream changed, and a growing number of middle-class families are quietly discovering something uncomfortable. The forever home they thought would create financial security is actually becoming the largest financial risk of their entire life. Not because homeownership is bad, not because houses are worthless, but because the modern economy no longer behaves the way it did when this advice was created. A forever home made sense in a world where jobs stayed stable for decades, where housing prices were low compared to income, where interest rates stayed manageable, where healthcare costs were lower, where mobility was less important, where pensions existed, where one income could support a household. That world is mostly gone now. Today, a forever home often locks people into massive debt at exactly the moment the economy is becoming more unstable. And the danger is not obvious at first, because monthly payments normalize slowly. The pressure builds quietly. One repair, one tax increase, one insurance increase, one job disruption. Suddenly, the mortgage payment doesn't feel empowering anymore. It feels heavy. And here's the dangerous part: nobody explains properly. A forever home reduces flexibility at the exact moment modern careers require more flexibility than ever before. 30 years ago, staying in one city for decades was common. Today, industries shift rapidly. Remote work changes markets. Companies downsize aggressively. Entire sectors disappear within a few years. The average worker now changes jobs far more frequently than previous generations. But a forever home assumes stability. It assumes predictable income, predictable geography, predictable expenses, predictable interest rates, predictable family structure, predictable health. And modern life is becoming less predictable every year. That mismatch creates risk, massive risk, especially because houses are not liquid assets. People love saying homes are investments, but investments usually don't require replacing a roof for $24,000. Investments usually don't punish you for moving. Investments usually don't come with surprise plumbing failures, rising taxes, HOA fees, or emergency maintenance. A forever home is part asset, part lifestyle purchase, part emotional decision, part debt contract. And the emotional part is where people stop thinking clearly, because buying a forever home feels like becoming an adult. It signals stability, success, status. People post photos online, families congratulate them, but almost nobody asks the uncomfortable question: what percentage of your future freedom did this house just consume? Because that's the real cost, not just the mortgage payment. The opportunity cost, the flexibility cost, the stress cost, the career limitation cost, the hidden maintenance cost, the invisible pressure cost. Let's do the math properly. Suppose that same couple pays $5,300 monthly toward housing. Over 30 years ignoring maintenance and tax increases, that alone exceeds $1.9 million. Now add repairs, maintenance, property taxes increasing over time, insurance, interest, utilities, furniture upgrades, emergency expenses. The real lifetime cost can easily cross $2.5 million for one house. Now compare that to a smaller home, or continued renting plus investing the difference. This is where people become emotional, because culturally, renting is treated like failure. But mathematically, renting is sometimes far safer, especially in unstable economies, especially when interest rates are high, especially when housing prices disconnected from income reality, especially when your career may require movement. The problem is that people compare renting costs only to mortgage payments. That comparison is incomplete. The real comparison should include total ownership cost versus total flexibility gained. A renter can relocate quickly for a better opportunity. A homeowner with a giant mortgage often cannot. A renter avoids catastrophic repair costs. A homeowner absorbs them fully. A renter can downsize rapidly during economic hardship. A homeowner may become trapped in an illiquid market. And this matters more today because economic volatility increased dramatically. In many industries, the safe career no longer exists. Tech layoffs, healthcare burnout, corporate restructuring, AI disruption, automation. The modern worker survives through adaptability, but a forever home often reduces adaptability. That's the contradiction nobody talks about. The bigger the house becomes, the smaller your financial flexibility becomes. And banks understand this psychology perfectly, because the forever home narrative benefits lenders enormously. Think about the language. Dream home, forever home, upgrade, building wealth. These phrases sound emotional because they are designed to bypass rational analysis. Nobody says, "Congratulations on your 30-year leveraged debt obligation." But that's functionally what a mortgage is. A very large debt agreement backed by your future labor. Now, to be clear, this does not mean homeownership is always bad. That would be lazy analysis. A house can absolutely build wealth under the right conditions. Reasonable price, stable income, manageable payment, strong emergency fund, long-term location certainty, healthy savings rate, low debt elsewhere. The problem is that many buyers today stretch far beyond those conditions because housing became emotional competition. People buy based on identity now, not affordability. They buy houses to prove they're progressing in life, even if the numbers quietly suffocate them afterward. And social media made this worse. People compare kitchens, neighborhoods, backyards, open floor plans, luxury finishes. Suddenly, a normal house no longer feels acceptable. Now people need their forever home. Even if that forever home consumes 50% of their income, that ratio is dangerous, especially because most people underestimate ownership costs massively. A mortgage payment is only the beginning. The house constantly asks for more money, always. A pipe breaks, the driveway cracks, the water heater dies, trees need removal, electrical issues appear. Insurance deductibles increase, property taxes rise again. The house becomes a permanent subscription service with unpredictable pricing. And unlike renting, there is no ceiling protecting you. One of the biggest financial mistakes people make today is assuming future income growth will solve today's overpurchase. They say things like, "We'll grow into the payment, promotions will come, we'll earn more later." Sometimes that happens, sometimes it doesn't. And when it doesn't, the consequences become brutal. Because large fixed costs destroy financial resilience. The modern economy punishes rigidity. The people surviving best financially today are often not the people with the biggest houses. They're the people with the most flexibility, low fixed expenses, high mobility, strong cash reserves, investment flexibility, career freedom. A forever home can quietly remove all of those advantages, especially for younger families. And there's another problem people rarely consider. Your forever may not actually be forever. Divorce rates remain significant. Family structures change, parents age. Jobs relocate. Health changes. Children move away. People evolve psychologically over decades. The house that feels perfect at 34 may feel financially exhausting at 49. But selling is expensive. Moving is expensive. Transaction costs are enormous. And if housing markets weaken during that period, people become trapped. This happened during the 2008 housing crisis. Millions discovered their forever homes were not assets. They were anchors. Some homeowners couldn't move for better jobs because their houses lost value. Others were underwater on mortgages. Some drained retirement savings just to keep properties they no longer truly could afford. And here's the uncomfortable truth. Many people today are repeating similar behaviors again. Not identical, but emotionally similar. Stretching budgets, assuming appreciation, believing housing only goes upward long term, treating giant debt as normal because everyone else is doing it too. That herd psychology is dangerous. Because housing markets do not care about personal dreams. The bank does not care that this was supposed to be your forever home. If payments stop, the emotional story disappears instantly. Only the contract remains. And that's why the forever home concept deserves more skepticism in modern finance discussions. Not fear, not panic, skepticism. Because financial security is not created by appearing stable, it's created by surviving instability. That's a completely different mindset. The financially strongest households today often optimize for resilience instead of appearance. They buy less house than banks approve them for. They maintain lower fixed expenses. They preserve cash flow. They prioritize liquidity. They invest consistently. They avoid becoming house poor. And house poor is one of the most psychologically exhausting financial states a person can experience. From the outside, life looks successful. Nice home, nice neighborhood, nice kitchen. But internally, every unexpected expense creates anxiety. Every layoff headline creates fear. Every interest rate discussion feels personal. Every repair becomes stress. That's not financial freedom, that's financial pressure wearing expensive clothes. And ironically, some of the wealthiest people understand this better than middle-class buyers do. Many high net worth individuals avoid oversized personal residences because they understand something important. A primary residence is usually not the highest performing financial asset available. It's primarily consumption with partial investment characteristics. That distinction matters because once you stop treating houses like guaranteed wealth machines, you start evaluating them more rationally. Can you comfortably afford it? Can you survive income disruption? Can one income cover essentials temporarily? Can you still invest consistently afterward? Can you maintain flexibility? Can you sleep peacefully with the payment? Those questions matter far more than granite countertops or extra square footage. And this is where the forever home narrative collapses for many modern buyers. Because deep down, many are not buying security. They're buying emotional reassurance. They want to feel established, complete, successful, certain. But certainty purchased through excessive debt is fragile certainty, especially in unstable economies. The truth is that your safest financial position today is usually not maximum ownership. It's maximum resilience. And resilience often looks less impressive externally. Smaller house, lower payment, more liquidity, higher investments, greater mobility, more options. But options are valuable, extremely valuable, because modern financial survival increasingly depends on adaptability, not permanence. The people who navigate economic shifts best are rarely the people with the largest fixed obligations. They're the people with room to breathe. That breathing room matters, a lot. Especially now. So before buying a forever home, ask yourself one difficult question. Are you buying stability, or are you buying a very expensive illusion of stability? Because those are not always the same thing, and confusing the two can become the most expensive financial mistake of your entire life. If this video changed the way you think about money, subscribe now. Because the financial decisions you avoid today usually become the financial regrets you pay for later.